Welcome to this Finance News Frontier Special Explainer. I'm absolutely thrilled to guide you through tonight's briefing. Okay, let's just dive right into this. We are looking at a truly unprecedented convergence of statecraft, institutional power, and decentralized finance. As we unpack all of this together, you're going to see the perfect macroeconomic storm that pushed Bitcoin to a historic paradigm-shifting milestone in May 2026. Make no mistake, this isn't just about a number going up. It's about the very architecture of global money being rewritten right in front of our eyes.
And, well, there's the number, $80,286.50. That was the exact price point hit on May 4th, 2026. Now, what's really fascinating here is what this represents beyond just the digits. Smashing through that $80,000 psychological and technical resistance zone signaled a permanent redrawing of global macroeconomic boundaries. For anyone who's been following this space, you know this wasn't just a technical breakout. It was total validation. It marked the exact moment a decentralized asset proved it could absorb massive global shocks and command institutional respect on an entirely new level.
So, how did we get here? Here is tonight's briefing docket. We'll be looking at 1. The geopolitical crucible. 2. Wall Street's thundering herd. 3. Washington's crypto policy pivot. 4. Altcoins and AI miners. And finally, 5. The new digital gold.
Let's start right off with Part 1, the geopolitical crucible, from Operation Epic Fury to economic fury.
Okay, so the most immediate driver of this wild market action was the sudden, frankly shocking, outbreak of the 2026 Iran war late this past February. This conflict delivered an immediate shock to global energy flows and severely disrupted the critical Strait of Hormuz. Let's walk through exactly how this played out. On February 28th, Operation Epic Fury kicks off with kinetic strikes. Then, by April 7th, Pakistan and China step in and broker a temporary ceasefire. Crucially, on May 1st, hostilities are officially terminated, and boom, just 3 days later, on May 4th, Bitcoin breaches the $80,000 resistance. That rapid de-escalation is absolutely vital to understand. Lifting that heavy geopolitical war premium was exactly what unlocked the market and paved the way for the breakout.
To really get how crazy this evolution is, you gotta look at what happened during the absolute height of the military escalation. Traditional markets completely faltered. The S&P 500 dropped 4%, and gold, the historical safe haven, tanked a staggering 17%. But Bitcoin, it completely decoupled. Driven by what looked like pure seller exhaustion, it actually rallied 7% from its $66,000 low. In real time, we watched it act as a borderless, censorship-resistant hedge for capital fleeing a literal conflict zone. Now, the kinetic conflict eventually stopped, but it immediately morphed into what the U.S. Treasury called Operation Economic Fury. The government shifted to aggressively disrupting the digital domain, freezing $344 million in sanctioned digital assets. It's wildly ironic, right? The U.S. Treasury actively weaponized the blockchain's own transparency against bad actors to track and halt those funds. That right there shows a massive maturation in state-level enforcement capabilities. Which brings us to Section 2, Wall Street's thundering herd and the ETF breakout. Because while geopolitics gave us the ultimate stress test, Wall Street built the concrete floor underneath this entire rally. Get a load of this number, 16,000. That is the number of brokers now authorized to actively and proactively sell Bitcoin ETFs to their clients. The industry is literally calling this the thundering herd. It's a massive democratization of access that's bringing a whole new wave of Main Street investors into the fold, all guided by their trusted, traditional financial advisors.
And just look at where that money is flowing. In April 2026 alone, spot ETFs saw an insane influx of $2.44 billion. BlackRock's IBIT fund is just crushing it with absolute market dominance, capturing 70% of those inflows. But they're not the only players in town. Institutional giants like Morgan Stanley jumped into the space and successfully drew a cool $100 million in just the first week of launching their MSBT fund. Make no mistake, the institutional floodgates are wide open.
All of this institutional muscle leads to a reality that honestly feels a bit surreal. Bitcoin's volatility has actually dropped below the S&P 500, the Nasdaq 100, and gold. Think about that. If you've ever had an advisor tell you crypto is too volatile for a retirement portfolio, this metric flips that entire argument entirely on its head. It tells traditional investors that the asset is undeniably maturing. And it's fortified by corporate diamond hands, strategic buyers like Strategy Inc., who are sitting on a massive reserve of 815,000 Bitcoin.
That kind of capital stickiness fundamentally changes how the asset behaves.
All right, Section 3, Washington's Crypto Policy Pivot. We're talking the Clarity Act and the Fed transition. Let's pivot over to Capitol Hill, where massive legislative roadblocks are just rapidly collapsing. Take a look at the framework of the incoming Federal Reserve Chair Kevin Warsh. He presents this really fascinating paradox. On one hand, he explicitly treats Bitcoin as a legitimate macroeconomic signal, even calling it the new gold for younger investors, which totally reinforces its store of value narrative. He also flat-out rejects a retail central bank digital currency, which is a massive tailwind for private stablecoins. But on the other hand, he's a monetary hawk. He favors QT for cuts, meaning he wants to shrink the Fed's balance sheet while lowering interest rates. That strategy tightens up the easy liquidity that highly speculative altcoins rely on, while heavily favoring sound money principles.
And all that feeds right into the momentum behind the Digital Asset Market Clarity Act. This proposed bill is a literal game changer. It clearly defines digital commodities under CFTC oversight, it provides a 180-day provisional registration window for firms to get compliant, and it legally prohibits the Fed from issuing a retail CBDC. If this passes, we are effectively looking at the end of the highly contentious era of regulation by enforcement. It provides the exact legal bedrock that even more institutional capital needs to deploy at scale.
Now, what actually broke the gridlock on the Clarity Act was the stablecoin compromise. Traditional banks were sweating bullets, and you can't blame them, worrying about a massive bank run of people pulling deposits to chase 5% stablecoin yields. So this compromise, brokered by Coinbase and the major banking lobbies, strikes a really brilliant middle ground. It bans pure passive yield to protect the banks, but it protects everyday Americans who are earning activity-based rewards for participating in networks. Finding that middle ground is exactly what cleared the path for a full Senate floor vote this May.
Which brings us to Section 4, Altcoins and AI Miners, the broader ecosystem pivot. Obviously, a rising tide lifts all boats, and Bitcoin's surge is radically reshaping the whole $2.73 trillion crypto market. Take Ethereum, for example. It is gearing up for a massive technological leap. The Glamsterdam upgrade in the first half of 2026 is targeting a blistering 200,000 transactions per second using parallel execution. Then the Hegota upgrade lays the foundation for a 95% reduction in Layer 2 fees, making those secondary networks insanely cheap to use. Combine all of that tech with the exploding restaking sector, and you can see why institutions are putting out price predictions of $15,000 for Ethereum by the end of 2026. But honestly, the most surprising data we found was right here. Look at the massive outperformance of public mining stocks. Even though Bitcoin itself was technically down 20% from its October 2025 peak prior to this breakout, miners like TeraWulf are up 85%, and Core Scientific is up 40% year-to-date. Why? Because they made a brilliant, lucrative pivot. They're diversifying away from just pure Bitcoin mining and repurposing those high-performance facilities into highly profitable AI data centers. It's a total game changer for their revenue models. Finally, Section 5, the new digital gold and the macroeconomic ripple effects. Let's bring this all home. We have to tie these isolated events back into the broader global economic landscape to see what this easing war premium actually means on a macro level. We're seeing a dual-factor movement play out. The US dollar index is cooling off to 97.90 as that war premium dissipates, which historically is a really bullish signal for digital assets. Meanwhile, the US 10-year yield is holding steady at 4.38%, and crude oil is finally cooling from its peak. It's also super interesting to contrast the US aggressively pushing for regulatory clarity with international moves, like Brazil recently banning the use of crypto for overseas remittances. The US is really cementing its role as the primary driver of all this institutional adoption.
But look, as your guides through this frontier, we have to give you the complete, objective picture here. The main downside risk amidst all this market euphoria is something being called macroeconomic whiplash. The lingering effects of that Hormuz disruption mean that persistent shipping and fertilizer inflation are still very, very real. The danger is that the sticky inflation could force the incoming Warsh-led Fed into significantly more aggressive economic tightening than the market has currently priced in.
So, that leaves us with one massive question to close out tonight's special report. Is this $80,000 milestone the new permanent baseline for global digital finance, fully fortified by undeniable institutional buy-in and regulatory clarity? Or is this just the peak before those lingering global inflation threats unleash a massive macroeconomic storm? Consider the forces at play, weigh the data we've walked through, and keep a very close eye on the horizon. Thanks so much for joining me for this explainer.
An investment in knowledge pays the best interest, so why not invest in this channel? Click like and subscribe for more.